Good morning. I'm Gord Long with the Financial Repression Authority. As part of our ongoing series on the Austrian School of Economics, I have John Butler joining us this morning from London. John is the publisher of the Amphora Report, author of the book The Golden Revolution, and Chief Investment Officer at Amphora Atom Capital. Welcome back, John.
Thanks, Gordon. Nice to be here.
But been probably a year now, how quickly the time goes. John, maybe a lot of our listeners, because we have so many new ones, may not have heard the first take, may not be familiar with yourself. Could you give us an outline of an overview of your personal background and Amphora?
Yes, my background is in international investment strategy. I worked as a macro investment strategist for Deutsche Bank and Lehman Brothers, among other firms. I was a managing director at both of those firms, running global teams that covered multi-currency, fixed income, and asset allocation strategy, also including commodities from a macro point of view. Starting in 2009, however, I started my own independent firm, Amphora. It's a boutique investment advisory and consulting firm, and I advise a select group of institutional, but also a few higher net worth private investors on both asset allocation topics and also specific investment strategies, not only for commodities, but also financial assets.
John, I said earlier that we're here to talk about the Austrian School of Economics. And in regard to this era of financial repression that we're in, what does that mean to you, the Austrian School of Economics? How would you describe it in your own words?
I mean, the simplest way to describe the Austrian school is that it's the no free lunch school of economics. That is, the Austrian school believes that economic systems are ultimately information systems. Some of those systems use information more efficiently and effectively than others. And in particular, systems in which authorities of various kinds meddle with the market, extract capital from the market through what could be high and efficient rates of tax, say, or who manipulate the money of that market through some sort of artificial interest rate policy. I mean, those policies might serve political goals, but from the Austrian economics point of view, anything that impedes the free price information flow of an economic system will result in a suboptimal economic outcome. Now, this leads some people to think, oh, wait a minute, Austrians are anarchists. No, it's not like that at all. Without the rule of law, without the ability to strongly enforce property rights, without the ability to prosecute fraud, and various other legal frameworks, the Austrian economic model can't work at all. So in fact, this idea that somehow, Austrians are nothing but a group of anarchic libertarian types, I don't want to disparage, libertarians, but what I'm getting at is the idea that somehow Austrians advocate a free-for-all is absolutely not true. But what they do want to do is make sure that economic information flows as efficiently as possible within this conduit of a solid legal structure.
What, would you consider yourself an Austrian economist?
Absolutely. Absolutely. I mean, my first exposure to Austrian economics was when I was 15 years old. I was required to read Hayek.
Well, that's unusual. That is unusual today in any school.
It was a high school economics course, and the gentleman, the teacher for this course, he actually grew up in Eastern Europe under the Warsaw Pact and Soviet regimes. And he and his family had managed to somehow get to the United States. He trained to be both a history and economics teacher, and he absolutely insisted that we learn at least a little bit about the Austrian school because his own parents apparently regarded the Austrian economists as the first to understand the inherent failings of a socialist economic system and the associated political repression alongside the financial and economic repression that caused.
Now, very interesting. Today, in almost any American university, the word Austrian economics is not even mentioned, never mind an understanding of it. John, how would you use how would somebody apply the Austrian school in investing? Are there some key tenets or principles of it that you would
Yes.
use?
Once you accept basic Austrian economic principles, there are a number of implications for for the way one would go about investing. First of all, you have a way to identify distortions, a very powerful way to identify distortions that are caused by some policy set, fiscal and monetary policy set. That is, be it interest rate manipulation or be it fiscal policy manipulation. The Austrians are able to look at these policies and they're able to see, to some extent, not with precision, but in generalities, how they are impacting the investment environment, both from a macro point of view and to the extent you're talking fiscal policies that target certain industries with certain types of regulations, taxes, subsidies, special privileges, whatever it might be. Then you get a sense of where the distortions are, and you get a sense of where, in theory, you should be relatively overweight or underweight from an investor's point of view. So take an example of the mid-2000s. In the mid-2000s, using an Austrian framework, you could identify very clearly that there were a range of policies, both fiscal and monetary and regulatory, that were providing disproportionate capital flow out of basic industries, say manufacturing, into housing in the United States. This was very much in evidence. There were a range of policies that indicated this. Indeed, relative valuations of corporations operating within the housing sector, these valuations had become disproportionately high compared to, again, basic industries, manufacturing, consumer staples, these sorts of things. And that was a huge red flag because you had both the cause, the source of the distortions quite easy to identify in a range of government economic and monetary policies on the one hand, and then you saw the distortions occurring in the valuations on the other hand. And so the obvious trade here was to go short of the home builders and others involved in residential construction and housing generally, also the financial sources for that, such as Fannie Mae, Freddie Mac. That was the short side of the trade, and the long side of the trade was just consumer staples, basic industries. And indeed, that would have been an extraordinarily good trade to hold once one had identified the housing bubble as having formed by, say, the late 2005, 2006. That's just one example.
What kind of examples are you using today at Amphora? How are you applying it today in today's environment? What things are you, what I'm saying is, what are you seeing right now?
Well, you're seeing a general overvaluation of risky assets, which has been caused by a truly unprecedented set of highly expansionary monetary and fiscal policies around most of the world, not all of the world, but most of the world. And so that's just in general created an extremely expensive environment for assets. But of course, there's nothing to stop that. I mean, if policymakers want to make assets ever more expensive in nominal terms, they can certainly do so. They have the policy instruments required to do precisely that. They can keep expanding the money supply. If they want, they can even try to force money velocity to rise by trying to give some of that money directly to consumers in the form of tax rebates or whatever it might be, in the event that the money they're creating gets clogged up in the banking system, which is what some prominent sort of Keynesian mainstream economists are arguing is today the problem behind the continued stagnation of the U.S. and global economy. So you've got generally expensive assets, but what you have found is that income growth has not kept. Assets are expensive relative to incomes. So the correct strategy here is not simply to short assets. That's dangerous. Policymakers can find ways to keep pushing up asset prices. But if indeed they do look for ways now to stimulate aggregate demand, consumer spending more directly, rather than working through the banking system, that will begin to push up consumer incomes and spending. But sadly, that's probably inflationary. Nevertheless, it does mean that inflation, that aggregate spending in nominal terms will rise, but it will not necessarily result in higher asset prices. And so the correct trades to have on today are trades that will perform if incomes begin to catch up to asset prices. So it could be asset prices declining towards incomes, or it could be incomes rising towards asset prices. Take your pick. and it's impossible to know which of those two is the one that is going to happen. But it is highly likely from this point forward that a conversion of the two will happen. And that is what we're focusing on today at Amphora.
So part of what you're referring to is often called helicopter money. That is when we bypass the banking system, or more formally called overt monetary funding or financing. And it comes in two forms, either direct money passed from the Treasury to citizens or tax rebates the other way. Is that realistically on the horizon for most of the developed world, in your mind?
They're certainly talking about it. It's not clear whether or not it is actually going to happen. That said, one needs to now put into perspective the large imbalances that have built up in the global economy over the past few years that these extreme monetary and fiscal policies have been in operation. And the concern here is the following, is that some countries, as we know, are large net exporters. They're fundamentally competitive economies. Say Germany, for example, is the largest of these. But then other economies are relatively inefficient economically overall, and they're very large net importers. These cumulative imbalances, that is, cumulative net exports, net imports, these imbalances need to be financed. And because the global reserve currency, the dominant global reserve currency today, is the dollar is behind most of this financing. But the problem is this. The problem is that if the United States then decides to implement some sort of quantitative easing version 4, unconventional policy version 10, negative interest rates, whatever it might be, the problem is that the dollar, as the source of financing for everything around the world, well, the dollar's own sort of store of value function eventually begins to come into question if the U.S. moves towards ever more aggressive policies. Take negative interest rates, for example. The dollars that are financing the global imbalances are held abroad because it's the U.S. is a net importer. So the balance of dollars as reserves is held abroad. This is what China holds. This is what Japan holds. This is what the oil producers hold. They hold all these treasuries and other dollar assets. Well, the problem is this, is that what if the U.S. tries to move towards a negative interest rate policy and the yield on treasury securities therefore becomes negative? That is a direct tax on those accumulated dollar reserve balances worldwide. Do you think the creditor nations like China and others, do you think the creditor nations are going to sit and allow themselves to be taxed by the Federal Reserve against these holdings? They're not going to want to do that at all. They will therefore reduce those holdings and seek to hold other alternative assets. Well, that will put downward pressure on the dollar. And as the dollar declines in value, that will again very clearly call into question its ability to serve as a store of value. If private investors around the world then get concerned dollars' role as a store of value, they'll reduce their dollar holdings as well. And of course, they don't want to be taxed for holding treasury securities either. So this will shift the demand function for dollars, and it will weaken the dollar. And this will create a stagflationary mix of conditions in the United States. Because as the demand function for dollar shifts, other factors equal, that will push up consumer prices. But the problem is that because the demand for dollar assets also declines, it will eventually, if allowed to run its course, send the negative interest rates into reverse, and you'll end up with a rise in dollar interest rates. It will begin to look very much like the 1970s, to use a very pertinent historical example here. And as we know, the 70s was the decade of the dreaded stagflation. It was a decade in which both stock and bond markets did poorly. It was a decade in which dollar assets in general underperformed international assets. It was a decade in which commodities held their value and rose in value in dollar terms quite spectacularly in some cases. That is the environment we're going to be getting into. And that's what investors need to prepare for.
Very, very astute. There is so much discussion that there's a strong possibility, whether good or bad, and you point out the issues, that we are moving to negative interest rates. Not negative real we've had, but negative nominal, and there's a war on cash because of the issue if you use cash, you need to limit the ability to pull it out of banks and therefore a cashless society. Comments on that thinking, not the thinking, but the real possibility.
Well, sadly, even getting to the point we're at now, you almost need to just accept that policymakers have become pathological. That is, they've got this relentless, we will do whatever it takes attitude to try and make their policies work. The problem is, of course, when you get pathological about these things, you can no longer question your original set of assumptions. An Austrian school economist knows that the original set of Keynesian/monetarist assumptions that have gone into forming this unconventional, aggressive, extreme policy mix, those assumptions are themselves flawed. And so sadly, you're on this course where if left to run itself the way it's going now, policymakers will move in these hugely counterproductive and disruptive directions,
Unfortunately.
because they just won't question whether their assumptions themselves are wrong. And so you get these, obviously very bright, PhDs in economics, many of whom are employed at the central banks as senior research staff. In some cases, they are on the boards of the central banks making the decisions themselves. And I mean, and they talk openly about how negative interest rates is simply a continuation of what they've already been doing with lowering interest rates. But it's not. And as you point out, it requires a ban on cash to be effective. Well, when you ban cash, how on earth are people living hand to mouth in these countries possibly going to get by? They won't be able to beg in the street. They won't be able to transact in a small way in their own neighborhoods. You will cause complete riot and chaos in any relatively economic poor part of the United States or other developed economies. I mean, these people have been hurt hard enough by all the asset inflation. They've been hurt hard enough by stagnant real incomes. Are policymakers really going to throw these people under the bus for good by banning cash? It's a terrible idea. It's terrible for them, but of course it's terrible for the economy as a whole. Austrian economists simply know better. And sadly, though, at the rate things are going, policymakers are going to teach everyone a very, very harsh lesson about just blindly accepting what the bureaucracy tells you to do when it keeps doing more of the same digging in an already deep hole.
Last question for you, John. I really appreciate your views on this as an Austrian. If we have a financial crisis or a serious stock market equity or bond market correction, we have pyramided the debt to such a level on collateral, there would be a tremendous erosion in collateral, which would almost be a contagious condition. What if we had a significant correction beginning? What actions would you suspect the developed world central banks would take? Could you speculate on that?
The problem is this: is that unless somehow negative interest rates can work, and I don't think they can for reasons we just went through, I think it's hugely counterproductive. But if negative interest rates, if we just assume they cannot work, and that policymakers will realize that they just shouldn't go there, that they'll come to their senses, as it were. The problem is this: if you do get a major correction in asset markets, if that does begin to cause collateral problems within the financial system, which it almost invariably will, exactly where I don't know, but the system is by definition opaque. I can't see into it clearly. The regulators can't see into it clearly either. In any event, if that happens, the problem is that policymakers are kind of out of options at that point. The only thing they can begin to do is to actually start outright capital controls, actually prevent investors being able to freely liquidate or withdraw funds from their existing investments, be it a bond ETF, be it a stock ETF. Sadly, that's kind of what you're going to need to do. If you want to stop a flood out of these funds when investors decide they want to go to cash, electronic cash, if physical cash is banned, well, that's the only way to do it, to lock people in. Now, that, of course, is very anti-capitalist. It's very anti-market. It goes directly against everything that a free enterprise economy should stand for. But when you follow these sorts of policies with supposedly good intentions, you eventually get into a dead end, and that's where we are. Dead end, checkmate, choose your metaphor. So investors also need to be concerned about this. The reason why, in some cases, asset allocation advice to institutional investors, I never leave out one of the chapters in my book of recommendations, which is that you simply must hold a material portion of your liquid net worth in physical allocated gold. Because if they're going to start shutting down the markets, not just manipulating them, but shutting down the markets, preventing withdrawals, and taking very capital control type measures, also probably at the international level, you simply have no way to use the financial system to protect yourself. They will simply make it impossible. So you've got to get out of the financial system entirely. Obviously, owning a house is theoretically a good idea if it's not over encumbered with debt. But owning physical allocated gold is a nice, liquid, historically tested way to have a complement and a bit of diversification vis-a-vis the value of a house.
John, we have to break now, but could you tell our listeners how they could learn more about Amphora and your writings and the things you're involved with?
Yes, I maintain a website, www.amphora-alpha.com. I also publish a newsletter, the Amphora Report. The website is a free resource. It's meant to just present my sort of business to the world, as it were. I produce my report as it stands now, free of charge, in a similar way to generate interest in my investment consulting and advisory business. Anyone who's interested in learning more about the services that I can provide, please feel free to contact me directly. My contact details can be found on my report or on my website.
John, great discussion. Really enjoyed having you, and we'll have to have you back later. Thank you very much.
Thank you, Gordon. My pleasure.
Bye-bye.